So first things about tax reform, I want to remember is, okay, what we are doing right now, we are preparing tax returns. They are tax returns for what year? 17. 17 is under old rules. So current tax returns are still under old rules, we are not changing that. Next year, but the rules kicked in today. So what we are doing today, the deals and transactions, they are under the new rules. But when the tax return for that will be? Next year, 1 year from now. So let's be very clear. You do not see these changes right now on your current return except a couple. You will see them a year from now. Next point here is the law is not finished. A lot of times people ask around us, okay, so what is the answer? Now anybody right now who tells you they know the answers to all the questions are either lying or they are Facebook accountants. You know, on Facebook everybody knows the answers. Be careful, because the more you know about tax reform, the more careful you are giving answers right now. The law is not finished. We accountants expect a lot of corrections, a lot of additional guidance, and there are tons of questions that do not have answers right now. So I read a lot about that, I interact with my peers, and even the brightest nationwide tax attorneys admit that the law is unclear at this point in quite a few areas, including what is pertinent to us, real estate investors. Next, so nobody understands it 100% already. I mentioned that, okay, you don't have to change anything, I want to throw it in right now. It's okay, so people are saying, oh my God, that huge change, what do I need to do differently today? I will return to that at the end of presentation. There will be a slide as far as who needs to worry right now, means who needs to make an appointment with me and discuss changes, and who does not need to. We'll return to that. But for most people, you can get away without changing anything you are doing. There was a lot of concerns, oh, I have to stop doing this, start doing this, immediately run, create LLC, incorporate, blah, blah, blah. Okay, chances are no. Okay, for most people in this room, the answer will be you don't have to change things you are doing. But for a few people, of course, it will be different. Okay, if you want to make those changes, it may save you money. Okay, before I go more into details, okay, I want to remind quickly ABC and also DE of 1040, which is IRS tax form for real estate investors. There are 5 schedules that we need to clearly understand what they are. Schedule A, B, C, D, E. So schedule, and what part of investing business goes on those schedules. So Schedule A is for personal and non-business investments. So what is on Schedule A, which you need to know is, okay, if you are an investor, if you are a private lender, if you are in notes or in owner financing, you probably were using certain part of that Schedule E of personal deductions. So Schedule E and itemized deductions affects you if you are private lender doing notes or owner financing. Also, people with self-directed IRAs doing investments there affected by changes to Schedule A. Schedule B is where you report interest, income that you receive, also from all of these, including if you are a private lender, if you receive interest on notes, owner financed properties. C is business schedule. Okay, who uses that schedule? If you are in wholesaling or doing flips, you definitely are using Schedule C. Like assuming you are not doing separate returns for your companies. Like obviously if you have partnerships, corporations, yes, these are separate returns. But if you are doing standard personal return, that will be on Schedule C. Now if you are doing private lending, notes, owner financing, sometimes you do use Schedule C, sometimes not. It depends on how it was set up. D is where you put capital gains when you sell properties, but I stress rental properties. If you sell flips, they do not go on capital gains. A lot of people are confused about that. When you sell flips, capital gains terms do not apply. It's not capital gains, period. So capital gains are when you sell rentals. And E is where you report current income and expenses from rental properties. So I'm assuming that we have a basic concept of what those A, B, C, D schedules are, and now I move forward. I will try to move quick. We'll leave room for questions, obviously, after that, because if we start asking questions in the middle, guys, we'll get sidetracked. Believe me, it's too much stuff right now to get distracted. Let me go through the presentation, and I will gladly answer your questions after that. Also, reminder for people who are making pictures of the slides, I'm flattered that you are doing that, but if you put your email on that, on that clipboard that is circulating around, I will email you those those slides, you don't have to rush and copy. Okay. On the personal side, I'm not going to stay on that. We will quickly run through that. Plus, you have it on that one-page handout that is printed. So what survived the reform on personal side? We still have the complexity of multiple filing statuses and 7 different tax brackets. They promised to simplify, they didn't have it. Core itemized deductions are still there. People, at some point there was a lot of talk about, oh, he's going to disappear, that is going to disappear. No, most of that stayed. We still deduct the same stuff. You know, sales tax, property tax, mortgage interest, all of that stayed. Some of that get modified, restricted, but it stayed. It did not get eliminated. Education credit, student loan deductions are still there. Capital gains rules did not change. The famous 2 out of 5 rule for excluding capital gains on selling your own residence did not change. There was a lot of concern it was going to change. No, it stayed the same. Amazingly, a lot of people, including CPAs, still today claim that it changed. No, they said it could change. That was one of the proposals, but it did not. AMT, the hated AMT, which is alternative minimum tax, which hits people with higher income, unfortunately did not get killed. It got pushed into higher income level, but is still there. On business side, what did not change is a lot of concern was, so what, I'm an investor, I have all of these properties, I heard that I now cannot deduct mortgage interest or property taxes. Yes, you can. It never was threatened to begin with. So investors can still deduct mortgage interest and taxes. Always was that way, always will be that way. Did not change. Whatever restrictions happened for your personal residence only. Next is rental income. There was a concern during one of the proposals that it will become subject to self-employment tax. No, it did not. And generally speaking, in the next line it says landlords are not discriminated against. Guys, there is very simple explanation why those things did not happen. What is that? Who writes the law? Who writes that law in Congress? They are landlords themselves. They are not going to shoot themselves in the foot, guys. You know, it's very simple. Okay, so there were side effects of some proposals, and when these guys would, oh, wait a second. You know, my deductions are going to go away. No, wait, no, that's not that. Depreciation periods stayed the same, so there were some rumors they were going to change. No, they did not. They stayed. 1031 exchanges, which all of us in this room love. And for those who don't know, it's the way to delay paying capital gain taxes when you sell a rental property. They stay, they are still there. We can still do them. They got much more interesting and more complicated because before 1031 exchange applied only to rental, to all kinds of assets, all kinds of properties. You could do it with real estate and a bunch of other stuff. For example, if you traded in a truck for a new truck, that actually was a 1031 exchange before. The rules changed. 1031 exchange right now apply to real estate only, which makes it much more difficult if you do cost segregation. If you don't know what cost segregation is, don't worry about that, it won't affect you. But if you know what it means, combination of cost segregation and 1031 exchange became much more tricky to do because of the twist. But big take home from the 1031 exchanges stayed. Sole proprietorship stayed. There was a lot of concern as, okay, everybody right now needs to incorporate. No, you don't. If you do business in your own name, you may want to create LLCs and companies for legal protection. I'm not an attorney, that's an attorney's area. I'm an accountant. As an accountant, I can tell you, your tax situation will not change. You don't have to